Hello students, this video is my fourth video for the chapter Amalgamation, Absorption and External Reconstruction. In my previous videos, I have clearly explained what is purchase consideration and the different methods of calculating purchase consideration along with examples. Today, I am going to explain about the model journal entries to be passed in the books of the transferor company, that is the vendor company or selling company. Let me proceed further now. Amalgamation, absorption and external reconstruction. In all the three cases, namely amalgamation, absorption and external reconstruction, the books of the selling company, which is liquidated, must be closed. Closing of the books of the selling company requires passing necessary journal entries. Let me proceed with the model journal entries to be made in the books of the selling company. Before that, one thing you should know, in this chapter, we have journal entries in the books of the selling company and journal entries in the books of the purchasing company. First, I will tell you about the journal entries to be made in the books of the selling company. So, let us see about the model journal entries in the books of the selling company, which is also known as vendor company or transferor company. So, bear in mind that selling company, vendor company, and transferor company, all these are one and the same. So, let us see what journal entries will come in the books of the selling company now. Before you start writing the journal entries, first you have to give the heading journal entries in the books of such and such company, whatever is the name of the selling company, that name you will mention. Okay. So let us see what will be the first journal entry. The first journal entry is for transferring assets taken over. For transferring assets taken over. So here you will be having a new account called as realization account because the assets will have to be realized, right? So what is the entry for transferring the assets taken over? The entry will be realization account debtor to sundry assets account. So let me repeat the entry once again. Realization account debtor to sundry assets account. Here there is a very important point which you will have to bear in mind. The point is that when you record the assets will have to be recorded individually. What do you mean by this? So when you're given the name of the asset like land, building, plant, machinery and so on, each and every asset will have to be recorded individually and they will have to be recorded at book values. So remember this point, keep this point in your mind. So when you enter the assets, when you give the entry realization account data to sundry assets account, each and every every asset will be mentioned separately, like realization account data to land, to building, to plant and machinery, to furniture, like that it will come. And not only that, one more point which you'll have to remember is that these assets will be recorded at their book values. To be very simple, they will be shown at the values which are shown as per the problem. Okay, so that is what is the book value actually. Then you will be writing the narration as usual. As I used to tell you always, any journal entry without narration is meaningless. So the narration here will be being assets taken over, transferred to realization account. Being assets taken over, transferred to realization account. Now, there are certain important points which are to be noted as far as this entry relating to transferring assets taken over is concerned. So, let us see what are the points which are to be noted here. The first point is that all assets, whether taken over or not, should be transferred. All assets, whether taken over or not, should be transferred. So what do you mean by this? Even assets which are not taken over have to be realized. Okay, so all these assets will have to be transferred. Even assets not taken over have to be realized. So all assets, whether taken over or not, should be transferred to realization account. But here is an exception. The exception is cash and bank balance. The only exception we have here is cash and bank balance. I hope you are able to understand why cash and bank balance can be exempted. The reason is when you take over the assets, when the assets are realized, the assets are going to get converted into cash. What do you mean by realizing the assets, selling the assets? So when you sell the assets, what will happen? The assets will be realized and you will get cash in return. Okay, whereas when you take the case of cash, cash is already available in its own form as cash itself. So there is no question of realizing cash. So no need to take cash. So other assets other than cash only will be realized and taken over. But sometimes in the problem, it may be given that even cash has to be transferred to realization account. In such a situation, you'll be transferring cash also. So that's why I have mentioned here. See the sentence: cash and bank balance. Cash and bank balances are transferred to realization realization account only if they are taken over. If it is specifically given that all the assets, including cash, were taken over, you will be transferring cash also to realization account. Otherwise, you will not take cash. Okay, that is one point to be noted. So, let us see what is the second important point to be noted here. Intangible assets. See this point. Intangible assets like patents, copyrights, intangible assets like patents, copyrights, and goodwill should also be transferred to realization account unless it is clearly given that they are worthless. If it is given in the problem that these intangible assets are worthless, then you will not take them to the realization account. Otherwise, even the intangible assets like patents, copyrights, and goodwill will be transferred to realization account. In case if it is given that these assets are worthless, what will be done? They are transferred to shareholders account as losses. When it is given that the intangible assets like patents, copyrights, and goodwill are worthless, in such a situation, what has to be done? They will be transferred. They are transferred to shareholders account as losses. So this is one more point which has to be kept in mind. So I have told you regarding the first journal entry. So what is the first journal entry? The first journal entry is for transferring assets taken over. So for transferring assets taken over, the entry is realization account data to sundry assets account. So entry number one is over now. So let us proceed with the second entry. The second entry is for transferring liabilities taken over. So the second entry is for what? It is for transferring the liabilities taken over. For transferring the liabilities taken over, the entry is liabilities account data to realization account. So while entering the liabilities, remember you have to enter the liabilities individually one after the other. Okay, I told you when you enter the assets will have to be entered individually, isn't it? Likewise, the liabilities will also have to be entered individually. So the entry will be liabilities account data to realization account. You'll be writing the narration as being transfer of liabilities taken over. So here is an important point to be noted. I have given it here. Liabilities not taken over. Liabilities not taken over or liabilities to be settled by immediate payment. Liabilities not taken over or liabilities to be settled by immediate payment by selling company should not be transferred to realization account. Should not be transferred to realization account. I hope you are able to understand this sentence. Should not be transferred to realization account. So if it is given in the problem that certain liabilities were not taken over, or if it is given in the problem that certain liabilities are to be settled by immediate payment, such liabilities will not be taken, will not be transferred to realization account. So, what has to be done with respect to those liabilities? For each liability not taken over, separate ledger account has to be opened. Separate ledger account has to be opened and it must be settled separately by the selling company and must be settled separately by the selling company. So, this is one important point which you have to note. Okay, so I have told you regarding the second journal entry now. So what is the second journal entry? The second journal entry is for transferring liabilities taken over. For transferring liabilities taken over, the entry is liabilities account data to realization account. So while entering the liabilities, I told you that you'll have to enter the liabilities individually, and those liabilities which are not taken over and which are to be settled immediately by the selling company should not be transferred to realization account. Now let us proceed with entry number 3. Entry number 3 is for purchase consideration receivable. So entry number 3 is for what? It is for purchase consideration receivable. So you know what is meant by purchase consideration. I've clearly told you about what is purchase consideration, what are the methods involved in calculating purchase consideration in my previous videos. So you can refer to those videos for better understanding. Okay. So, what is purchase consideration? Purchase consideration is the agreed amount which the transferee company, that is the purchasing company, pays to the transferor company, that is the vendor company or selling company, in exchange of the ownership of the transferor company. Okay, so this is what is the meaning of purchase consideration. So, for purchase consideration receivable, what is the journal entry? The journal entry is purchasing company's account data to realization account. Purchasing company's account data to realization account. So, whatever is the name of the purchasing company, that name you will have to mention here. Okay, so let me repeat the entry again. For purchase consideration receivable, what do you mean by purchase consideration receivable? It is due, it is not yet received. Okay, so for purchase consideration receivable, the entry is purchasing company's account data to realization account. So you'll be writing the narration as being purchase price receivable. So let us proceed with the fourth entry now. The fourth entry is for receiving purchase consideration. So the fourth entry is for what? It is for receiving purchase consideration. So for receiving purchase consideration, what will be the journal entry? Let us see now. So the journal entry which you will make here depends upon how the purchase price was received. That is in what form, whether it is received in the form of cash or whether it is received in the form of shares or whether it is received in the form of debentures. So the entry will be bank account data, bank account data, shares in purchasing company account data, debentures in purchasing company account data to purchasing company's account. So whatever is the name of the purchasing company, that name will come here. So if it is received in the form of cash, you'll be debiting bank account. If it is received in the form of shares, you'll be debiting shares in purchasing company account. If it is received in the form of debentures, you'll be debiting debentures in purchasing company account. And which account will get credited here? The purchasing company's account will be credited. So which account will be credited? The purchasing company's account will be credited. Why will the purchasing company's account be credited? Because who gives the money to whom? The purchasing company gives the consideration to the vendor company or the selling company. Right? So what is the rule in accountancy? The rule in accountancy says that credit the giver. Who is the giver here? The purchasing company is the giver. That is the reason why we give a credit to the purchasing company's account. One important point I would like to tell you here before you proceed with the journal entries, as far as this chapter is concerned, first of all, be very clear regarding which company is the selling company and which company is the purchasing company. Okay, be very clear with respect to that point. Otherwise, if you understand it the other way, all your journal entries will go wrong. Okay, so now let us proceed with point number 5. I'm sorry, entry number 5. For realizing assets not taken over. Entry number 5 is for what? It is for realizing assets not taken over. So when some of the assets are not taken over, those assets will have to be realized. What do you mean by realizing? It means selling, right? When the assets are sold, what will happen? Cash will be received in return, isn't it? The rule says debit what comes in, credit what goes out. Since cash comes inside, you give a debit to the bank account. So for realizing assets not taken over, what will be the entry? Bank account data to realization account. The next entry is for payment of liabilities not taken over. When some of the liabilities are not taken over, those liabilities will have to be settled and they'll have to be paid. So for which the journal entry is liability account, the concerned liability's name will come here, liability account, debtor to bank account. So what is the entry? What I have written in blue, just note it, liability account data to bank account. Why do you credit the bank account? The rule says debit what comes in, credit what goes out. So when payment is made, what will happen? Cash will go out of the company, isn't it? So that is the reason why you give a credit to the bank account. A respective liability account data to bank account will be the entry. Now, if the payment is made at a premium, if repayment is made at a premium, when a more amount is paid than what is actually the actual amount, then it is a loss to the company, isn't it? So, with all losses, realization account will be debited. With all gains, realization account will be credited. Okay. Since paying at a premium, repayment at a premium is a loss to the company, you will be giving a debit to realization account. So, if payment of liabilities is made at a premium, the entry will be liability account data, realization account data to bank account. Sometimes the repayment may be made at a discount. If the repayment is made at a discount, it is a gain to the company. So, when there is any discount on repayment, that is a gain to the company, in which case realization account will be credited. So, if the repayment of liabilities is made at a discount, in such a situation, the entry will be liability account data to bank account to realization account. So, depending upon the information available in the problem, you will be passing the journal entry. So, this is the journal entry for payment of liabilities not taken over. So, you will be writing the narration as being payment of liability at premium or discount, as the case may be. Right? Now, let us proceed with entry number 7. The seventh entry is for payment of realization expenses. So seventh entry is for what? For the payment of realization expenses. So for payment of realization expenses, with journal entry will come depends upon who pays the realization expense, whether it is borne by the selling company or whether it is borne by the purchasing company or whether the expenses are reimbursed by the purchasing company. Okay, so it depends upon all this. So we'll be having corresponding journal entries. So first, if expenses are to be borne by selling company, if expenses are to be borne by selling company, the entry will be realization account data to bank account. Realization account data to bank account. So all these journal entries you are making in the books of the selling company only, isn't it? So for when payment is made, when expenses are borne and when payment is made, cash goes outside. So debit what comes in, credit what goes out. So you give a credit to the bank account, being payment of expenses of liquidation realization by selling company. So that is a narration. Then the next entry is if expenses are to be borne by the purchasing company. So if expenses are to be borne by the purchasing company, the entry will be purchasing company's account data to bank account. So what will be the entry? Purchasing company's account data to bank account. Then the next situation is when liquidation expenses are reimbursed by the purchasing company. Okay, if the purchasing company gives back the amount, if it returns the amount, that is what is meant by reimbursing. In such a situation, the entry will be bank account data to bank account, bank account data to purchasing company's account. Why bank account data to purchasing company's account? When the amount is reimbursed, returned back by the purchasing company, cash comes inside the selling company. So debit what comes in bank account data. Who is the giver? The purchasing company is the giver. So credit the giver. So purchasing company's account gets credited. So the relation will be being expenses paid reimbursed by the purchasing company. So which journal entry will come depends upon the information which is provided in the problem. So that is actually regarding the seventh entry, that is payment of realization expenses. Okay. Now let us proceed with the eighth entry, that is for discharging debentures. So debentures, shares, all this will have to be discharged now, isn't it? So for that, let us see what journal entries will come. The debentures may be discharged either at a premium or at a discount. So let us see what will be the entry when the repayment is made at a premium. Okay, for discharging debentures at a premium, So let us see what journal entry will come. Debentures account data to debenture holders account. That's a basic entry. And when it is discharged at a premium, it's going to be a loss to the company. So you'll be giving one more debit to the realization account. Why do you debit the realization account? Because when it is discharged at a premium, when it is repayable at a premium, it's going to be a loss to the company. So realization account gets debited. So in such a situation, when it is repayable at a premium, the entry will be debentures account debtor, realization account debtor to debenture holders account. So you'll be writing the narration as being the amount of debentures and premium payable credited to the debenture holders account. The next entry is for repayable at a discount. When it is repayable at a premium, I said that it is a loss that has to be debited to realization account. Now, when it is repayable at a discount, it is a gain and it has to be credited to realization account. The discount amount will have to be credited to realization account. So, the basic entry is debentures account data to debenture holders account. In addition to that, since repaying at a discount is a gain, you give one more credit to realization account. So when it is repayable at a discount, what will be the entry? Debentures account data, to debenture holders account, to realization account. The narration will be being transfer of debentures after adjusting discount on repayment. Now this entry is for payment to debenture holders. Okay, so that is actually due, and this is for actual payment. For payment to debenture holders. For payment to debenture holders, what will be the entry? Debenture holders account debtor to bank account if cash is paid, and if the settlement is in the form of debentures, to debentures in purchasing company account. This will be the entry. Debenture holders account data to bank account to debentures and purchasing company account. Why do you debit debenture holders account? Debenture holders account is debited because debit the receiver. Who is the receiver when payment is made to the debenture holders? Debenture holders are the receivers, isn't it? So you are giving a debit to the debenture holders account. So this will be the entry for payment to debenture holders. So what will be the entry? Debenture holders account data to bank account to debentures and purchasing company account. The next entry is for discharge of preference share capital. Like how you discharge the debentures, preference shares will also have to be discharged. So here again, for repayment at premium. For repayment at premium, the entry will be preference. So it's actually preference share capital account data to preference shareholders account. There you had the entry as debentures account data to debenture holders, isn't it? Instead of the word debentures and debenture holders, we are substituting the words preference shares and preference shareholders here. Okay. So what will be the entry? Preference share capital account data to preference shareholders account. So this is for repayment, preferential capital account data to preferential holders account. If the repayment is at premium, it is a loss to the company. So that will be debited to realization account, like how we did in case of debentures. So in such a situation, in which situation, when repayment is at a premium, the entry will be preferential capital account data, realization account data to preferential holders account. So being transfer of preference share capital and premium payable to preference shareholders will be the narration. The next situation is for repayment at discount. When repayment is at discount, it's a gain to the company. So you will be giving a credit to the realization account. So what will be the basic entry? The basic entry will be preferential capital account data to preference shareholders account. In addition, since the repayment is made at a discount, to the extent of the discount, you will be giving a credit to the realization account. Why? Because that's a gain to the company. So being transfer of preference share capital after adjusting discount on repayment will be the narration. So that is actually these are the entries for the amounts due to the preference shareholders. Now this entry is for actual payment to preference shareholders. For payment to preference shareholders. So for payment to preference shareholders, what is the entry? Preference shareholders account data to bank account if cash is paid, to shares in purchasing company account if payment is made in the form of shares. Okay, so preference shareholders account data to bank account to shares and purchasing company account. So why do you debit preference shareholders account? The rule says debit the receiver. Who is the receiver here? Preference shareholders are the receivers. So we are giving a debit to the preference shareholders account. So if the payment is made in the form of cash, credit will be given to bank account. If the payment is made in the form of shares, credit will be given to shares in purchasing company account. See, actually, you have a list of entries, isn't it? The list goes so long. Don't have a feeling that so much is there, how to keep all this in mind. Actually, if you understand the reasoning behind every debit and every credit, remembering all this will not be a problem at all. And one more thing is that I'm giving you all possible entries. It's not that all these entries will come in all the problems. Depending upon the information provided in the problem, the necessary entries only you will make. Okay. So this is what is the entry for payment to preference shareholders. So you'll be writing the narration as being settlement of the claim of the preference shareholders. After discharging debenture holders and preference shareholders, the next entry is for transferring equity share capital and accumulated profits to equity shareholders. So this entry is for what? This is for transferring equity share capital and accumulated profits to equity shareholders. Okay. So for this the entry will be equity share capital account data, general reserve account data, profit and loss account data, any other reserve if available account data to equity shareholders account. So whatever is given in the problem as equity share capital, that will be transferred to equity shareholders. Then if you have general reserve, profit and loss account or any other reserve in the problem, all that will be transferred to equity shareholders. And this will be the entry. So the narration will be being transfer of capital and accumulated profits to the equity shareholders because they are said to be the owners of the company, isn't it? So all this will be transferred to them. Then for transfer of accumulated losses, whether there is profit or loss, it has to be transferred only to the equity shareholders. The previous entry was actually for transferring the equity share capital and accumulated profits to the equity shareholders, and this entry is for transfer of accumulated losses. For transferring accumulated losses, you'll be debiting the equity shareholders account. Since it's a loss, equity shareholders account gets debited. So equity shareholders account data to profit and loss account, to preliminary expenses account, to discount and issue of shares account. These items usually will appear on the asset side of the balance sheet, which will be given in the problem. So this is what is the entry for transferring accumulated losses. The narration will be being transfer of accumulated losses to equity shareholders. Now we have come to the stage of finding out whether there is realization profit or loss. Okay, so generally we used to prepare realization account as a ledger account, and if you get a balance on the debit side of the realization account, that will be profit, and if you get a balance on the credit side of the realization account, that will be loss. So both profit as well as loss will be transferred only to the shareholders. So if there is profit on realization, the entry will be realization account data to equity shareholders. So equity shareholders account will be credited if there is profit, and if there is loss on realization, the entry will be exactly the reverse. So what will be the reverse entry here? If there is loss on realization, the entry will be equity shareholders account data to realization account. So being loss on realization debited to equity shareholders account, that will be the narration. Okay, so after doing all this, finally payment will be made to the equity shareholders, and that will be the last entry. So the last entry is for what? For final payment made to the equity shareholders. So here the entry will be equity shareholders account data to bank account if final payment is made in the form of cash, and to shares in purchasing company account if final payment is made in the form of shares. So what will be the entry? Equity shareholders account data to bank account to shares in purchasing company account. Why do you debit the equity shareholders account? Debit the receiver is a rule. Who are the receivers here when payment is made to equity shareholders? Equity shareholders are the receivers. So equity shareholders account data to bank account to shares in purchasing company account being final payment made to the equity shareholders, that will be the narration. So as I told you already, it's not that all these 13 entries will come in all the problems. So I have given you the maximum possible entries which will come in the books of the selling company or the vendor company or the transferor company, right? Depending upon the information provided to you in the problem, you will be getting the entries. Is it okay? So I think you're clear with what all I have told you now. Hope you are clear with all the journal entries I have explained today. In my next video, I'll be working out a problem involving the pausing of journal entries in the books of the Transferar company. If you like this video, subscribe to my channel. Thank you very much for watching this video.